high inflation, possible stagflation. It's finally hitting home. Is this conflict going to be so protracted that this becomes, at least for a while, the new normal? Dana?
Yeah, thank you. I do think that we're in for potentially a fairly persistent bout of inflation at this point. It's difficult to see how we're going to be able to move away from that. I think obviously the Fed is going to move forward with rate hikes. Everyone expecting that. Unfortunately, that's bad for markets as well. So stagflation, of course, this situation where you're battling inflation, but you're also now seeing dampening growth. So you have a Fed that has to fight inflation, right? We can't keep disadvantaging Main Street savers who need to buy non-discretionary goods in order to kind of save markets. But on the other side, of course, higher interest rates are going to hurt markets at the same time that we're having a geopolitical crisis hurt growth.
Barry, how do we arrive at the right conclusion? Do we look at the history of conflicts to see how they play out, or do we look at the reaction to the markets in the history of conflicts? Because this one may not be as simple as some of the previous ones where it was just a buying opportunity because it didn't last that long. If this is the beginning of, at least months or years of conflict, it seems different than the first Iraq War, for example.
I think that's a fair point, Joe. But what it brings me to is, and I heard you and Becky earlier talking about the role of energy in 2008, and that Iraq War is another example. In fact, we were already in recession in 1990 when Iraq rolled into Kuwait, and that was a consequence of the Fed raising the funds rate to 9%, the savings and loan industry collapsing, the household sector was under some degree of pressure. So it wasn't really energy that caused us to tip into that brief recession. Same story in 2008. The consumer sector had been in recession already for a year and a half when energy prices spiked to 150. It really began with house prices peaking out in 2006. So if you compare that to the current environment, just look at household net worth, which plunged 16% during the 2008 cycle. It took till 2013 to regain that hit to household net worth. Household net worth is 26% above where it was at the beginning of the pandemic. There's $2.6 trillion in excess savings. The bottom quintile of income earners, incomes and wages are going up 3% faster. So it's a long-winded way of saying the household sector is in a much stronger position to absorb the price shock here. And what's really important is the mix of growth, Joe. So we were already moving from less consumption to more investment in 2022. S&P 500 bottoms-up investment is 21% of where it was in 2019. That's what's going to drive CapEx, productivity, and labor income, which is surging, by the way. So I just think that we're in a much stronger position to absorb this than we were in 90 or 08. And like the pandemic, we're going to find that the U.S. Private sector is far more flexible than people think right now, and that this is going to turn out to be a pretty good opportunity to put some money to work in the cyclical sectors.